There is a kind of seller in the market that does not read the headlines, does not care about earnings, and does not have an opinion about the future. It sells because price fell. That is the entire reason. And when enough of these sellers act at once, an ordinary dip can turn into something that looks like panic, even though nothing fundamental has changed. These are the systematic funds, and understanding how they work explains one of the strangest features of modern markets: why selling sometimes begets more selling with no news attached. Here is why you should care even if you never touch a futures contract. These funds are enormous, and they all tend to move the same direction at the same time. In August 2024, when markets wobbled, this machinery was estimated to unload on the order of $100 billion of equities globally in just a few sessions. That is not a bet on where the market is going. It is a mechanical response to how much the market is moving. When you understand that, you stop asking what news caused a sell-off and start asking who was structurally forced to sell. So, who are they? The two big families are trend-following CTAs, short for commodity trading advisors, and volatility-targeting funds, which include risk parity. Together, managed futures alone command more than $350 billion of assets, topping around $348 billion by the end of 2024. Trend followers buy what is rising and sell what is falling across stocks, bonds, currencies, and commodities. Volatility target funds do something related. They aim for a steady level of risk. The key is that neither one is forecasting. They are both reacting to the tape, and that reaction is where the story begins. Now the machine itself, and it is a loop. Start with volatility targeting. A fund wants, say, a fixed amount of risk. When markets are calm, volatility is low, so to hit that risk target, the fund uses more leverage and holds more stock. When volatility jumps, the same target now requires less exposure, so the fund must cut positions, selling into the very weakness that raised volatility in the first place. Trend followers pile on. As price falls through their models, they flip from long to short, adding more selling. Each wave of selling pushes price down and volatility up, which forces the next wave of selling. That is the feedback loop. It is not fear, it is arithmetic. And it runs in reverse on the way up, which is why these funds also chase rallies and can add fuel to a melt-up. August 2024 showed the loop in the open. As the yen carry trade unwound and volatility spiked, banks estimated that volatility control and trend strategies would dump roughly $70 to $80 billion of shares on the first Monday alone, with tens of billions more to come over the following sessions. Bank of America put the total CTA selling near $100 billion globally. The Bank for International Settlements later documented how this systematic deleveraging amplified the turbulence. The people hurt were not the funds, they were mechanically de-risking. It was everyone who assumed the calm of July would simply continue into August. So the next time a sell-off feels bigger than the news behind it, ask a different question. Not what happened, but who was forced to act. When volatility rises, a whole class of funds has to shrink, and their shrinking is itself a source of more volatility. That does not tell you what the market will do next. It is a lens, not a signal. But it explains why markets can look calm for months and then break in days, and why the same machinery that magnifies the fall can also stretch a rally far beyond what fundamentals alone would justify. The forward question is simple. What happens the next time volatility is this compressed for this long?